Have you ever wondered how businesses, from the little coffee shop on the corner to these huge corporations, keep track of every single penny? Well, the secret is computerized accounting. And in this explainer, we're going to demystify how software has totally revolutionized finance, turning these messy old ledgers into what feels like automated magic. So let's jump right in.
To really appreciate the new way, you kind of have to understand the old way. For centuries, accounting meant endless, painstaking manual entries in actual physical books. It was just a marathon of paperwork, and it was so easy to make a mistake. A single error could take hours, sometimes days, to find and fix. Then, computers showed up and, well, they changed the game completely. This slide just captures that revolution perfectly. Over on the left, you see the old way. One sale meant writing it down multiple times. You'd write it in a journal, then you'd have to copy it over to a ledger. That's double the work and double the chance of messing something up. Now, look at the right. A cashier makes one single entry, and the software, bam, instantly updates everything. The sales, the inventory, and even the accounts receivable, which is just a fancy term for the money your customers still owe you. It's a total game changer.
So what do you get from all this automation? Well, it boils down to 4 massive benefits. First, it's incredibly fast. Second, it slashes human error, which means way better accuracy. The whole process just becomes so much more efficient. And maybe most important of all, it gives you reliable financial data that you can actually trust when you're making those big business decisions. Okay, so how does the system actually produce all that reliable data? Well, it all starts with creating a kind of blueprint for your business's finances. And this blueprint has a name. It's called the chart of accounts. And let me tell you, it is the absolute foundation of your entire accounting system. So the official definition here calls it a complete listing of all accounts. That's a little dry, right? I like to think of it more like the skeleton of your business. It's the underlying structure that gives all your financial data its shape and its meaning. Every single transaction, I don't care if it's buying a pen or selling a jet, has to be categorized and put into one of these accounts. This quote is just the perfect analogy. Seriously, imagine trying to find something in a book with no index. It would just be a messy jumble of pages, right? Well, it's the same thing here. Without a chart of accounts, all your financial records are just a meaningless pile of numbers. It provides that essential structure to make sense of everything. And here's a super simple example of what one looks like. Notice how everything gets its own little category? Cash is an asset. That's stuff the company owns. Accounts payable is a liability. That's money the company owes to other people. And then, of course, you've got your income from sales and your expenses like rent. This simple, organized structure is the real key to the software's magic. So now that we have our financial blueprint, our chart of accounts, all set up, let's look at the daily flow. We can now start recording the 2 most fundamental activities of any business on the planet, making sales and making purchases. So let's imagine you're the business owner for a second. A customer walks in, they buy something. How do you actually get that sale into the system? It is literally as simple as these 3 steps. You choose if they paid in cash or if it's on credit. You fill out a really simple form with all the details, and then you just hit save. And this is the most important part. The system does all the heavy lifting in the background, automatically posting that transaction to all the correct accounts. No extra work for you. And here is the magic. While you were just filling out that simple little form, the software instantly created this perfect accounting journal entry. It knows to increase accounts receivable. That's the money your customer now owes you. It also records your sales revenue and something called VAT payable. That's the sales tax you collected that you'll have to pay to the government later. All of that done for you automatically. Okay, so that's income. That's money coming in. But what about the other side of the coin? How does the system handle it when you have to spend money? You're probably going to notice this looks really familiar, and that's because the logic is exactly the same. You select the purchase type, you enter the details from your supplier's bill into another simple form, and as soon as you save it, the system, again, automatically updates all the right accounts for you. And there's the result. The system automatically increases your inventory, it tracks the input VAT, that's the tax you paid on the purchase, which you can often get back, and it records a liability called accounts payable. Remember that one? That's the money you now owe to your supplier. Again, all of that complex bookkeeping happens from one simple entry. So you've been recording all your sales and purchases, and the system has been doing its job perfectly. But how can you be absolutely 100% certain that everything is accurate? Well,
That's where the final and maybe the most crucial step comes in, the bank reconciliation.
Bank reconciliation is basically a detective process. You're comparing two sets of records, what your books say you have in the bank versus what the bank says you have. The goal is super simple. Make those two numbers match. And if they don't, you got to figure out exactly why. So let's set up a little scenario here. You look at your accounting software, and it says you've got 45,100 pesos in the bank. You're feeling pretty good about that? But then, you get your official bank statement, and for that very same day, it's showing a different number, a lower number, and all of a sudden, you've got a little mystery on your hands. So, who's right? Is your software wrong? Did the bank make some kind of mistake? Or is there something else going on here? This is how we solve the puzzle. And it turns out, neither one is wrong. They're just a little bit out of sync because of timing. For example, your books didn't know the bank gave you a little interest income or that they took out a service charge. And at the same time, the bank doesn't know about a check you wrote that hasn't been cashed yet or a deposit you made that's still processing. These are the clues we need to solve the case. And once we make all those little adjustments for the timing differences in the items that weren't recorded, voila, both sides now perfectly match at 45,000 pesos. You've just proven your records are accurate, you've updated your books, and now you have a true picture of your cash situation. And this really brings us to the whole point of all of this. Accurate accounting isn't just about tracking what happened in the past, it's about shaping the future. With a reliable, automated system, you move from just keeping records to gaining real-time financial intelligence. You can see what's profitable, you can see where you're overspending, and you can see when it's the right time to invest in growth. So the real question isn't just about the numbers themselves, it's about what smart decisions this new power is going to let you make.